Where should you invest your money in 2018? That's the question we're asking all week on Inside AB, and we are starting with global stocks. I'm Jeremy Lawrence, and I'm joined here by Eddie Taylor. Eddie, you've been speaking to Stephen Rees, a senior investment advisor at JP Morgan Private Bank. What did he tell you this week?
Well, he's actually quite bullish about stocks in 2018. He's very, very excited about what they can offer, despite the bull runs of the last few years, particularly in 2017, with stock performances going through the roof and hitting multiple highs. He actually thinks that there's a lot of room to grow next year, and is advising people to rebalance their portfolios and put more equities in them. He tends to look at an annual return of around about 10% for his high net worth clients. So he's looking that he can achieve that this year, even though he might have to work a little bit harder for it.
Okay. Let's start, we're talking global stocks here, but let's start on his home turf. What's he saying about America?
Yeah, as we talked about, the multi-year highs, a lot of people are thinking, well, it's going to crash, it's got to come down. He really takes the other view. He still thinks there's more room to grow. He's looking at things like the legislative framework. He's looking at things like the US tax law that we'll come on to in a minute. But he thinks that they aren't overbought. He thinks that actually that the part of this recovery is longer and it's slower, which means that it isn't like any other kind of cyclical recovery that we've been in. So he's looking at, particularly the first 6 months of the year, US stocks really do have a lot of wind behind them, and they can go even higher.
Right, this time it's different, yeah?
This time it's always different, yeah.
So let's drill a little bit more. Why precisely does he think this recovery, after 9 years on a bull run, why is it still going to carry on?
Well, I think that the big thing was the huge piece of legislation that was passed in Congress at the back end of last year, which was the tax cut. Dropped the US corporation tax rate to 21%, which is really unprecedented. It was mid-30s before that. And that was actually beyond even the expectations and the aspirations of all of the lobbying groups. They wanted it sort of a 2 or 3% cut, but they got this massive cut down to 21%. That's going to have a huge impact on basically what companies do with their money. So it isn't simply about growth through cutting, it's actually now through investing, through expansion, about finding new markets, about R&D, that kind of investment that perhaps wasn't there for the whole of this recovery. That's now going to start to happen here.
Okay, well, we saw Apple's 30 billion investment in their home market, 20,000 jobs over the next 5 years. Perhaps that's part of this picture. And
we're seeing that a lot. We're seeing a lot of kind of like one-off bonuses and also wage increases as well. That's going to stimulate more growth in the economy as well.
Okay. But obviously, after so many years, there's not going to be any bargains. So where else should investors be looking in 2018?
Yeah, I mean, emerging markets is always going to appeal to investors looking for slightly more margin, looking for slightly more potential for growth. I mean, even though US stocks might have a little bit room to grow, they don't have a huge amount to grow. So there aren't any cheap stocks, there aren't any value stocks out there. So people will be increasingly looking to emerging markets. Brazil seems to be a bit back in vogue, but China's the big one.
Okay.
China's the one where people are always going to look for growth, simply because of the scale of the economy, because of the centralized nature of the economy, because of the control of the money supply. But also I think there's an embrace of technology, there's an embrace of innovation there. And what was interesting was that Stephen Rees actually looked at 2 or 3 sectors where he thinks that there is real interesting movement, and that's in clean energy and technology, dealing with the likes of, transport and the congestion and the pollution that affects the big cities like Beijing. So that's where he sees, in the emerging market sense, some real opportunity.
Okay. We need to talk about commodities when we're looking at 2018.
Yeah, it's a bit boring, to be honest with you. Not a great deal happening. Gold is trading at sort of 13.25, 13.30 right now. He actually set a year target of 12.75, so there isn't going to be a great deal of movement. If anything, it's going to be a bit downward.
Could there be a flight to gold from Bitcoin?
I think there was an awful lot of flight to gold from Bitcoin the last couple of weeks.
And then back again.
And then that might now reverse. Now things are starting to go green again. I think that if there's any reason to move into gold, it won't be through cryptos, which is still such a small part of the market.
Yeah.
I think that gold is a hedge against inflation. It's a hedge against insecure stock markets. And while we might get a bit of inflation towards the end of the year, particularly in the US, I don't think that the circumstances are right for a large flight to gold yet. So there's still probably a bit of neutral to downward pressure on gold this year.
You said boring commodities, but oil's back up to nearly 70 from a low of $28 3 years ago. That's not really boring.
It's not boring, but I think that's done now. I think that's done certainly for the short to medium term. I don't think there's a great deal of increased pressure on the oil moving northwards. There are 2 factors at play here. There's the OPEC have still got their cutting supply regime in place. There might be a bit of increase in demand from China, but I think the kind of the $70 barrel where we are now, that's pretty much the range it's going to trade for most of the year.
Okay, because of course if it gets too high, shale comes back into the equation. That's not good for this region.
Exactly.
Okay. So overall, we're looking at choppier, possibly more volatile year ahead, but there is still money to be made according to the analysts.
Yeah, I mean, it's not going to replicate 2017. That was almost a smooth, straight line up the graph on pretty much every indices. So I think we're looking at people having to work a little bit harder, maybe having to work a bit smarter, maybe doing a bit more research, maybe looking perhaps maybe at more managed investments rather than passive funds like ETFs. But I think overall the picture is, yeah, you're going to get your returns, but you just might have to be a little bit more switched on.
Great. Well, that's Global Stocks in 2018. Tomorrow we are talking UAE stocks. So join us then and do subscribe to our YouTube channel. See you.
Thanks.